Inflation is up, jobs are down. Is the Fed still in control or buying time? This is Macro Matters and we're talking about the Fed. The US Central Bank is being pulled in opposite directions. Inflation is still running hot, but the jobs market is showing real cracks. And with political pressure mounting, Fed independence is being tested like never before. A rate cut next week seems almost certain, but how deep will it go and what happens next? Let's ask Jeff Scholes, Head of Economic and Market Strategy at Clearbridge Investments. So Jeff, let's get the question out of the way. Is the possibility of a jumbo cut next week still on the table?
Well, although it's a possibility, I don't think it's going to be a high probability. Yes, the labor market is weak. Yes, inflation is running a little bit higher than consensus expectations or the Fed would like, but ultimately the Fed is going to do a dovish 25 basis point rate cut, and I think we're going to see some follow through in October and December. And I think at that point, doing 75 basis points worth of rate cuts, which is similar to what you saw in 1995 and 1998, I think the Fed's likely going to pause, and I actually don't think we're going to see more rate cuts next year. But I think from an investor standpoint, this is a good development because the Fed is finally starting that rate cutting cycle.
Well, easing policy with inflation at this level would be a rare step. Is 3% the Fed's new inflation target?
It's not. Unfortunately for the Fed, obviously you're seeing tariff-induced inflation. And when you look at the Fed's policy tools, they have the tools that can really address demand-driven inflation. If rates are going higher, that means mortgages, car payments, your credit card payments are all more expensive. And this is obviously driven by supply side issues. And when you think about tariffs, it's like a tax on the consumer. People are going to be paying more for their car or their furniture, and that means that there's less disposable income for other things, which will ultimately create lower demand and lower inflation as you look out on a longer term time horizon. So although we will be seeing 3% inflation prints for a while, when you look towards 2026, inflation should continue its trajectory lower towards the Fed's 2% target.
Meanwhile, let's look to the labour market now. And initial jobs claims this week just jumped to the highest in almost 4 years. Is the labour market in crisis?
It's not. The labour market is stalling, but it's not in crisis mode at the moment. We got some revisions lower from the QWEC numbers earlier this week, and it shows that the U.S. economy has been creating sub 50,000 jobs over the course of 2025. But when you look out to 2026, there's a lot of reasons for optimism, not only in the labor market, but for the economy overall. You have the Fed that's going to start to cut, and that's going to run through the economic bloodstream of the economy next year. You have the peak fiscal impulse of the One Big Beautiful Bill hitting in the front half of next year as consumers get larger tax refunds. And you're going to have better visibility on the trade front, which should supercharge corporate animal spirits, resulting in more capex and ultimately better hiring. So although we are seeing a lull in hiring at the moment, I'm envisioning a much rosier picture in 2026.
Dissent is growing, though, among the Fed, and policymakers are being punished over their policy. Can the Fed escape President Trump's control?
It can. Obviously, when you look at Fed Governor Cook and the mortgage misrepresentation case, this is going to get kicked up to the Supreme Court. And ultimately, if the court decides that the president does have the ability to determine what causes for being let go, that could weaken the protections of Fed governors and shield them from political pressure. But I think more importantly, when you look to the Wilcox case earlier this year, when Trump was able to let go of some of those regulators, the Supreme Court did carve out the Fed specifically to retain their independence. And when you look at the market really hasn't flinched on this development. So obviously this is something that bears monitoring. And if you do see the Fed independence start to weaken, that could result in higher treasury yields, wider credit spreads, and then also lower valuations for U.S. equities. But given that Wilcox case, I think the Supreme Court will likely rule in favor of keeping Fed independence intact.
But what about next year? Would we see the start of a halting cycle?
Well, next year, I think 75 basis points and the Fed is going to be done. I see a very strong year economically speaking. But also, if we do get more inflation, more than what I'm anticipating, because of that One Big Beautiful Bill stimulus, if the IEEPA tariffs get refunded back to U.S. companies, and that's being heard by the Supreme Court over the fourth quarter, that could be around $100 billion, which are going to U.S. corporations, which will likely be used for CapEx, hiring decisions, and ultimately could create more inflation. So we could very realistically see a scenario in the back half of 2026 where the Fed needs to reverse course and potentially hike rates as we get later in this economic cycle. But I think for now, investors are focusing on the fact that rates are coming down and ultimately will support the economy.
That was Jeff Schultz from ClearBridge Investments. Don't forget, you can watch more videos on Reuters.com.